Hey everyone, welcome back to Corporate Decoder, the place where we decode your favorite companies and figure out what their latest filings mean for their future. Today we're diving into SmartFinancial Inc. And let's just say they've been busy making some money moves that could really shape things for them. We'll break down exactly what's going on with this report and what it means for the company. Before we jump in, make sure you are subscribed to Corporate Decoder. We break down complex financial document linked in the description below, where we discuss these companies and more. So SmartFinancial Inc. just dropped a report letting us know about a pretty big deal they made back on August 20th of 2025. Think of this like a company making a significant announcement about something major they've done. This is SmartFinancial Inc. You probably know them as SMBK. They are traded on the New York Stock Exchange. Now, this specific report is called a Form 8K. Companies file these when something really important happens that the public needs to know about quickly. It's like getting an immediate update on major company events. SmartFinancial's main thing is their common stock, which is what people like you and me can buy and sell. This is what they trade on the New York Stock Exchange under the ticker symbol SMBK. The biggest news here is that on August 20th, 2025, SmartFinancial made a pretty significant agreement. They took out a new loan, but it's a bit different from what you might expect. They signed what's called a subordinated note purchase agreement. This means they essentially sold debt or IOUs to certain investors. And when we say subordinated, it means if the company ever had serious money problems, these new loans would be paid back after other more senior loans. So these new investors are taking on a bit more risk. They issued a $100 million worth of what they call 7.25% fixed to floating rate subordinated notes that are due in 2035. Let's break that down. They borrowed $100 million for the first 5 years from August 2025 until September 2030. The interest rate is fixed at 7.25% per year. That's a pretty specific rate, and it means the company knows exactly how much interest it will pay during that time. But after September 1st, 2030, things change. The interest rate then becomes a floating rate. This means it will change over time based on a key financial benchmark called the Secured Overnight Financing Rate, or SOFR, plus an extra 3.85% on top of that. SOFR is basically a benchmark interest rate that reflects the cost of borrowing overnight using Treasury securities as collateral. So from 2030 onwards, the interest SmartFinancial pays will go up and down depending on market conditions. This adds a layer of uncertainty for them on how much they'll pay in the future. What are they doing with all this borrowed money? A big part of it, up to $40 million, is going to be used to pay off some of their existing debt, specifically their 5.625% subordinated notes that were due in 2028. So they're essentially refinancing some of their debt, swapping out older, slightly cheaper debt for this new higher interest debt. The rest is going towards general company needs. It's important to note how they sold these notes. They did it through a private placement. This means they didn't sell them to the general public on an open market, but rather directly to specific investors who met certain criteria, like being accredited or qualified institutional buyers. This is often done to speed up the process and avoid some of the more public regulatory hurdles. And because they sold these privately, they also entered into a registration rights agreement. This is basically a promise to the investors that SmartFinancial will eventually register these notes with the government. This allows the investors to freely sell them later if they want to. If SmartFinancial doesn't follow through on this promise, they might have to pay extra interest to the investors. This is a common practice to make private placements more attractive. All these notes are governed by a formal document called an indenture. This is the master contract that lays out all the rules and terms for the notes and who is overseeing it all. In this case, US Bank Trust Company National Association acting as the trustee. Now, about paying back this $100 million, or actually getting rid of it. The company has some flexibility. Before September 2030, they can only call back all of the notes, and only if some very specific conditions mentioned in the indenture happen. But after September 2030, they have more freedom. They can choose to pay back all or part of the notes on any interest payment date. It's crucial to remember these notes are unsecured. That means there's no specific asset backing them up. And as we talked about, they are subordinated, meaning they rank lower than other debts. This is a key point to understand their risk profile. This section basically just restates what we covered in item 1.01. It confirms that SmartFinancial has indeed taken on this direct financial obligation. Nothing really new here, just a confirmation. This part is about how they communicated this information. Regulation FD, or fair disclosure, is a rule that says companies have to share important information with all investors at the same time. Here they mention they provided an investor presentation to potential buyers. They are including a copy of this presentation with their public filing. This gives us a peek into how they pitched this deal to investors. Finally, we always see this section in company filings. It's a legally required warning about forward-looking statements. These are statements about what the company expects or plans to do in the future, like using the money they raised or how their exchange offer might work. The company is essentially saying that these future predictions are not guarantees. Things could happen that make the actual results very different from what they're saying now. They list out potential risks and advise that anything they say about the future should be taken with a grain of salt, as actual outcomes can differ significantly. This last section is like the appendix of the report, listing all the supporting documents that were filed along with it. Here you see Exhibit 4.1, which is the actual indenture, a big detailed contract outlining the terms of the new notes. Then there's Exhibit 4.2, which is the template or the actual form of the note itself. This shows exactly what the note looks like and its terms. Exhibit 10.1 contains the form of the subordinated note purchase agreement we discussed, the main document for the debt issuance. And Exhibit 10.2 is the registration rights agreement, the document that promises them they'll be able to sell these notes publicly later. Finally, Exhibit 99.1 is that investor presentation they mentioned earlier. This is often where you get the most digestible, if slightly more promotional, overview of the company's strategy and the deal itself. And down here at the bottom we have the signatures. This is where leadership like the president and CEO officially signs off, confirming that everything in the report is accurate to the best of their knowledge. William Y. Carroll Jr. signing off here on August 20th, 2025. So what's the big story here with Smart Financial? They've raised $100 million in new debt, which comes with a higher interest rate than some of their existing debt and shifts to a variable rate in the future. This move could be about strengthening their capital position or perhaps preparing for future growth, but it also means higher interest expenses down the line, especially if interest rates continue to rise. They're essentially swapping out some debt for new debt that's more expensive long term. This isn't always a bad sign. Companies do this to manage their finances, but investors should always watch how this impacts profitability. The fact that they are also providing an investor presentation suggests they are being transparent with their stakeholders about this significant financials, but investors should always watch how this impacts profitability. The fact that they are also providing an investor presentation suggests they are being transparent with their stakeholders about this significant financial transaction. The forward-looking statement section always reminds us that while companies plan for the best, the future is uncertain, and we need to keep an eye on how these plans actually pan out. Now for my take. Smart Financial is navigating the current economic landscape by issuing new debt, but at a higher cost. This signals a proactive approach to capital management, but carries the inherent risk of increased financial leverage and future interest rate sensitivity. Their strategy of refinancing older debt with this new issuance indicates a potential need to bolster their capital base or perhaps fund strategic initiatives aimed at growth. However, the jump in interest rate from 5.625% on older debt to 7.25% plus a floating component on the new debt is notable. This could put pressure on their net interest margin, which is so crucial for banks. An opportunity here for them is if they deploy this capital effectively for profitable ventures that outstrip the increased cost of borrowing. A key risk that stands out is the floating rate component, which could significantly increase their interest expenses if market rates climb higher than anticipated. Another risk is the subordinated nature of the debt, which means it's a less secure form of borrowing, potentially impacting their creditworthiness if things go south. In conclusion, Smart Financial is making strategic moves to manage its capital structure. While the acquisition of $100 million at a higher interest rate represents a commitment to financial flexibility, it also introduces increased financial risk through higher interest costs and future rate fluctuations. Investors should monitor their profitability and how efficiently this capital is being used. Alright, that's our breakdown of Smart Financial's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think this debt is a smart move or a risky bet? Drop your thoughts in the description for more discussions. Thanks for watching. See you next time.